Hello, everyone, and welcome. Thank you for joining us. My name is Tom Essay, and I'm the editor of the Sevens Report. You probably recognize my name from your inbox. We send periodic content excerpts throughout the week, and that's most likely how you found out about this webinar. We're trying something a little bit different today. We're trying to provide some market analysis through a different medium, so we appreciate you being here. And with that, we'll get right to it. One of the things I love about working in this business is that it is populated by some of the funnier and more creative people across industries. Everybody in the markets and on Wall Street seems to have a pretty good sense of humor, or at least that was the way it was when I started, and it's definitely to a point still true today. One of those people is this guy Ivan the K, who I follow on Twitter. And he posted this sort of hilarious mock dot plot after the Fed meeting yesterday. And it's really apropos because I think a lot of us have, kind of thrown up our hands at the Fed here, if not just yesterday, but probably over the previous months and quarters. The Fed is such a shell of itself, if I can say that, from when I started in this business, and most likely when you started in this business too. It's a far cry from the days of Greenspan and even Volcker before that. But the Fed is what it is at this point. It's a variable that we have to try and plan for. And unfortunately, throwing your hands up through this dot plot is about as accurate as their current dot plots. Because we just don't know what they're going to do. And you get the impression they don't know what they're going to do. But I learned when I started my career on the floor of the New York Stock Exchange that you have to trade the market that you have, not the market you wish you had. So this is sort of the setup for us as we go into the end of the year. But I thought this was a pretty funny and apropos chart. So if you're on Twitter, follow Ivan the K. It's worth a laugh every once in a while. Getting down to business, what we're here today to do is to talk about what we expect from markets in the fourth quarter. And before we do that, I want to provide a little context for how we got here. And by here, I mean 2180 in the S&P 500. And there's really a singular reason. Basically, it all has to do with Brexit. From April 2015 to June 2016, the S&P 500 was largely stuck at 2100, and you can see it there on the chart. There were several attempts to break through, and they all generally failed. Then Brexit happened. Now, as we all know, Brexit was a tremendous surprise in multiple ways. One of the ways it was a surprise, other than the outcome, was that it sparked a stock rally. And the logic behind that rally was this. Basically, when Brexit was passed, investors assumed that global central banks were going to release more stimulus in an effort to get ahead of any sort of Brexit-inspired global economic slowdown. When global central banks were going to release that stimulus, it would send global bond yields even lower than they already were. And that would allow stocks to increase their valuation ceiling. And what I mean by that is there's a relationship between what a 10-year treasury yield yields and then what is a reasonable valuation for stocks. We call it the equity risk premium. And to use a sort of simple example, if the 10-year yield's at 3%, then buying stocks at 16 times earnings is about as high as you want to go. If the 10-year yield is at 2%, then you can buy them at 17 times earnings. If the 10-year yield is at 1%, you can buy stocks above 17 times earnings and still not be too crazy on a valuation basis. And that was the reasoning behind the breakout, the post-Brexit breakout in June. And it worked. I mean, as you saw, as you can see on the chart, bond yields plunged after Brexit, and stocks, after 15 months of trying, finally broke out above 2100, 2120, and really moved considerably higher. And it looked like for a while we were about to enter a melt up that was going to last the remainder of 2016. But then something happened. And what happened was bond yields didn't keep falling. And it's not just treasuries, it's global bond yields. And if you've been reading any of our excerpts, you know that we've been much more focused on Japanese and bond yields than treasuries. But all three of those yields stopped declining because little by little evidence was mounting that global central banks weren't going to unleash more stimulus, as the fallout from Brexit really wasn't that bad, at least not so far. So bond yields stopped going down. They turned around and they started heading higher, and they've largely retraced the entire post-Brexit decline. So, not surprisingly, the stock market rally stalled. We call it in the report to our paid subscribers, we called it the forever low rate rally, because the whole thesis was based in the idea that rates were going to stay forever lower than where we had thought they were going to be. Well, as that thesis eroded, the reason to buy stocks at these levels also eroded. And as you can see, that's what caused really the 3% pullback that we saw in the beginning of September. Now we're bouncing back a little bit, but that is the reason that this rally, the July rally, really stalled right now. So where does that leave us? Well, for the rally to re-engage, for stocks to really materially break out from here, one of three things has to happen. Number one, global bond yields need to start going back down. And I don't mean the declines, we're seeing today where the 10-year is like back down to, 1.63, 1.62%. I'm talking about the 10-year treasury going below 1.6%, below 1.5%, and down towards 1.4%, because that will help to inflate the valuation ceiling on stocks, and it'll help stocks break through 2,200. The second thing that needs to happen, again, it's one of these three, U.S. economic growth needs to accelerate. If we can get GDP to move towards 3% and above, that will create a rising tide that will be good for businesses, good for stock prices, and it will help valuations as well. And I bet the S&P 500 would be able to break through 2,200 decisively if we get a rising economic tide. The third, if we see earnings estimates go up for 2017, currently they're at about $130 per share for the whole S&P 500, full year 2017 S&P 500 EPS. If that number goes towards 135 or 140, then you can stretch the level of the S&P 500 and still stay within a reasonable valuation level. Here's the problem. None of these things are happening right now. And especially with the global bond yields, yes, they're down post-Fed, but the Fed meeting yesterday is not going to be the start of a significant decline in global bond yields. And so none of these things are happening right now. So what does that mean? Does that mean that the outlook for stocks is bearish? Well, no, it doesn't. Generally speaking, there is still a tailwind on stocks, but it does mean that the S&P 500 may be capped at around that 2,200 to 2,210. Again, I get that number by doing 17, which is the current multiple that people are willing to pay, times $130 per share. That's the full year 2017 EPS earnings, and that equals 2,210. A capped market is vulnerable to macro shocks. And if we want proof of that, all we have to do is look back to last year. We had a capped market that was capped at 2,100 for 15 months. And during that period, we had several macro shocks. August of 2015, December of 2015, and then January, February of 2016. And those macro shocks created sharp, short, nasty pullbacks that hurt performance. So my concern isn't so much that we're all of a sudden looking at a bearish market. Instead, it's that we're looking at a repeat of what we saw prior to Brexit. And that makes navigating this market a bit more tricky than it's been over the last couple months. So what do? Well, you have to do two things at the same time. First of all, you have to know, and you have to know before your competition, because you got to get ahead of the market here, if one of those three catalysts for a market breakout have been met. So if 10-year treasury yields go through 160, through 150, towards 140, stocks are going to break out and you want to get long. If you see GDP and economic data start to turn higher and we can move towards GDP of 3% or higher between now and the end of the year, that's a rising tide for stocks. That will help the overall market and stocks can break out. And then finally, if we see earnings actually start to be revised higher for 2017, and this is sort of the most vulnerable out of all of them, because right now it looks like that 130 number, if there's risk to that 130 number, it's risk of it being reduced, not of it being increased. So you have to know whether these three conditions for a stock breakout are met, and you have to know before your competition, because again, you don't want to be chasing markets. Chasing markets, especially in this type of environment, is dangerous. You want to get ahead of the move. At the same time, you also have to avoid any macro shocks by having somebody who is watching the macro horizon for you. And there are macro shocks out there. I'm sort of surprised, or potential macro shocks out there. I'm surprised by how sort of complacent a lot of analysts and investors are with the macro outlook for stocks. First of all, the election's looming. I mean, we have the first debate, which is going to be unbelievable coming on Monday. But beyond that, there's a very important Italian vote coming in November that basically could take Italy down the path of Brexit if it goes one way or the other. There's what the ECB is going to do, whether or not they're going to extend QE. And then there's always China, which has been pushed back to the back burner. But as we know from the last couple of years, seems to have this tendency to pop up when everybody's least expecting it. So between now and December 31st in Q4, there are plenty of macro shocks we need to watch. That's basically where we come in, and that's what we're going to be doing for our subscribers. We're going to be watching to make sure they know ahead of time if one of those three conditions for a stock breakout has been met, or conversely, if we think there's a significant risk of a macro shock and what to do to protect portfolios and protect performance. The Sevens report, for those of you that don't know who we are, it's a daily macro research report. We call it the Sevens report because it's delivered by 7 a.m. each morning, and you can read it in 7 minutes or less. We try to give comprehensive analysis, stocks, bonds, commodities, currencies, as well as economic data. We cover all of that every day so that our subscribers have a very good grasp on the total market, but also at the same time are never blindsided by an event. Because as we all know, macro risk doesn't just come from the stock market anymore. It comes from bonds, it comes from commodities, and it comes from currencies. We're not a recap sheet. Recap sheets in today's environment are free. What we do for our paid subscribers is we basically condense the information and then we make it applicable. We tell them what happened across all markets, and we tell them what it means specifically for stocks, bonds, commodity, and currency holdings, so that when a client asks them, hey, what does the Fed meeting mean for my bond holdings? They have a specific, well-reasoned opinion. And then we go through and we tell specifically how we can protect portfolios or profit from the events we're talking about. We give specific ETFs, we give specific strategies. One of the most recent ones you've probably seen was our higher rate playbook that we gave last week. We didn't say enact this. We said this is what you need to know what to do in case rates do go higher. And that's an example of how we make our research very applicable with specific ETFs so that our customers and our subscribers can outperform. Every day, we help thousands of advisors from national brokerage firms and RIAs do three things: save research time, increase market knowledge, and outperform. If you name a brokerage firm, we probably have a subscriber there. And these are the reasons people subscribe to our report. We, on average, save our subscribers an hour of research time a day. That's feedback from our subscribers. We can just make that number up. We increase their market knowledge. A lot of our subscribers use the Sevens report for talking points. They will read the report before they go to a client meeting or a prospect meeting, and they will have those talking points in their head so that they can speak quickly and intelligently on virtually any market topic a client or prospect might bring up. And that helps them obviously increase AUM and increase retention. And then finally, we do provide idea generation. We're not perfect, nobody is, but over the life of this product, we have helped our subscribers outperform with tactical idea generation. The particulars: subscriptions are $195 a quarter. That's $65 a month. And in today's research marketplace, we feel that that's reasonable for what we deliver. And frankly, compared to some of our competitors like Gartman and things like that, it's downright cheap. There is no penalty to cancel. We are a pay-as-you-go service. We have to earn your business every single quarter. There's no penalty to cancel. And retention is a strong point for us. Our business is built on retention. So we offer a 2-week grace period where if you cancel within 2 weeks, you get a full refund of your initial purchase. No questions asked. You just write us in, say, it's not for me, and you get your money back. If you are interested in subscribing, you can go to our website, sevensreport.com/subscribe, or click the subscribe button that is below this presentation. And what we want to do, we have a few minutes left. So what I want to do is answer a couple questions people wrote in. And this is a question from Bob. We try and make these things interactive. Basically, what Bob wanted to know is, what is our S&P 500 price target for year end? It's the first question. Bob, I would not be surprised if we stay where we are right now, maybe a little bit lower. Up a couple percentage points probably makes sense, barring any sort of significant macro surprise. So basically we could, if we're somewhere between say 2100 and current levels, I think that's a pretty reasonable expectation. Again, that'll change potentially depending on what happens, with the Fed, with that Italian vote, with the election, and with the ECB. But for right now, I'd say we're going to finish close to where we are. Another question: would you buy gold now? It depends how cute you want to be. We think gold is a sort of a compelling value at 1,300 or a little bit below. A very strong risk reward there over the medium and longer term. Some people don't like to quibble about, $30 or $40. We try to be pretty precise, but generally speaking, we think gold is in an uptrend. We do think that we have not seen the highs. And then finally, oil and gas stocks, because we do cover a lot of commodities. Do you think it's time to buy oil and gas stocks? No, is the short answer. I don't. If you have them, I would hold them. Doesn't mean I'd jump out of them, but I'm not sure about adding incremental capital here. The fundamentals on oil are cloudy at best, shall we say, and Tyler, who covers oil for us, can speak more to that if somebody wants to email in a question. But until the fundamentals turn decidedly more positive, I think that energy stocks, there is risk there. So I would not be adding more capital. Although again, I would be holding them now if you have bought them lower. So that's about all the time we have. We try and keep this about 15 minutes, but thank you very much, everyone, for coming and listening to our first webinar. We're going to try and do these more often, just provide analysis and some interactivity here in a bit of a different way. So we hope you've enjoyed it, and everybody have a great rest of your day. Thank you very much.